Hello, welcome to Options Brew TV. I'm your host, Lex, and tonight's special guest is Ryan Jones. Ryan has a long history in the options business with over 30 years of trading experience. Today, Ryan is still a trader, but also an educator, a mentor, a signal provider, among other things we're going to learn about. But he mainly focuses on option strategies and risk management. Tonight, Ryan will touch on high probability weekly income option strategies and compounding that thought. Okay, so we're going to learn about that. So Ryan, come on. Let's turn the camera on and introduce you. Welcome to the show, my friend. How are you?
Aloha. Thank you, Lex. Appreciate the opportunity.
Absolutely.
We all wish we were in Hawaii this
right. So pre-show, we got to talk. I saw you had your OU shirt on, which is Oklahoma, right? So we talked a little bit about that.
We're Center.
Yep, good. Yeah. Not an OSU fan though, right? Oklahoma State. That's taboo.
No, I'll root for them if they're playing Texas, but no.
Okay, no Texas fun then, right?
no Texas fun. Matter of fact, all my clients who are Texas fans have to pay me more.
Oh, that's funny.
So that's just
all right. No Texas talk. All right, good. So, you, from the bio, 34 years experience. Did you ever trade on a trading floor at all, or was it always off floor?
Always off floor. I started as a teenager in high school.
Okay.
So it basically self-taught and more or less obsessed with it from a very early age, and that has never changed.
Okay, so you're self-taught. That's awesome. So I'm sure you read books, and from what I know about you, I think you're also an author. Is that correct?
I am. Matter of fact, I was the youngest author to ink a deal with John Wiley and Sons on the topic of compounding or risk management, and that was at 26. So I'm not going to tell you how old I am now, but that was a few years ago, and there's no rewrite of that book. All of the stuff is the same. I use it the same as it was. So
okay. So and what's the name of it? I'm sorry. So we can get that out there.
Yeah, it's called The Trading Game.
Okay. The Trading Game. And where can they get it? They have to contact you to get it, or we can go to the Amazon machine and get that stuff?
Yeah. No, you can go to Amazon and get it. Absolutely.
Okay. I put it in the chat. So good. Okay. That's awesome.
Yeah.
Well, great. Ryan, I understand you have some ideas tonight. Let's talk about your income strategies. And I think it's pretty cool stuff. I think you're going to share a screen, right? And you're going to talk about how you kind of conduct this whole deal. Is that right?
Yeah. Okay. What I'm going to do is I'm just going to do two parts. Basically, one first on compounding, because that's the foundation. You have to understand that in order to appreciate the option strategy that I'm going to show after that, and that would be part two.
Okay.
Perfect. All right. So I've got a lot of information. I'm just going to fly through this stuff fairly quickly. So you can interrupt me if you have questions, if I'm going too fast or whatever, but there's just a lot. So the title of the presentation is How to Achieve Low Risk Geometric Growth. And basically it's divided into two parts, as I said. The first, I'm going to focus on achieving geometric growth, which is through risk management or compounding. And then we're going to apply that material, that understanding, to a low risk weekly option strategy, which I will fully reveal in this. I'm going to give you the basics and the foundation of that option strategy. All right, so as I get into this, there's one decision that is made by every single trader every single time they get into a trade. And it is the most important decision that you will ever make as you're taking these trades. And it is also, as it turns out to be, the least understood decision. And screwing this decision up, which most traders do, can easily cost tens of thousands, if not hundreds of thousands of dollars over time, as I'm going to illustrate as we go through this. And so, most traders don't realize what this is, but what that decision is trade size. And trade size really that's what risk management is. That's what compounding is all about. It's about determining what the trade size is on whatever it is that you're trading, based on your risk tolerance levels, based on your goals, based on the trading strategy that you're trading, et cetera, et cetera. And I'm telling you, I've been in, as Lex, you said, I've been in the industry for over 30 years. And I know for a fact that most traders don't have a clue about the far-reaching, unsurpassed ramifications of not understanding this critical piece of information.
Okay.
It is absolutely it's concerning, to be quite frank, because it literally drives everything. When you understand proper compounding, it drives every decision you make, including the strategy that you trade.
Mhm.
And so what we're going to do, for me to illustrate this and just drive this point home, is we're going to play a game, and it's a game that every single one of you would absolutely play if it were possible.
Okay.
If they had this in Vegas, we would all be flying to Vegas to play this game. So this is not trading, but it does drive home the point. So what I'm going to do is I'm going to flip a coin. Not really, but I'm going to flip a coin in the air 100 times. And every time the coin lands heads up, you're going to win $2 for every $1 that you bet on the flip of that coin. All right.
Yep.
If the coin lands tails up, you're going to lose $1 for every $1 you bet on the flip of that coin. Okay. So if you win $2. If you lose $1. And I'm going to give you $100 to bet with.
Mhm.
Okay. So that's your starting trading account size. And we're going to rig the game. It's already rigged, but we're going to rig it to ensure that you absolutely win 50% of the time. And of course, you coin flip, it's going to be 50-50,
Mhm.
but it might be 51-49.
Sure.
You get it.
Yep.
We're going to just say it's going to be 50-50. We're going to rig it, make sure everything is set. And so the question is, how much are you going to bet of your $100 on each flip of the coin? And if you were to bet $1 on every flip of the coin, after 100 flips, your $100 would turn into $150. That's math, it's period, it's fixed, it's not going to change. All 50 winners can happen, followed by all 50 losers, or vice versa. It's always going to come out the exact same. Period, end of story. All right. So it is a mathematically fixed situation in your favor. So your job, since this is a rigged game, your job is to grow your $100 as much as possible after 100 flips of the coin. Okay. That's your job. And by the way, that's your job with your trading account, period. And when you look at it that way, it's a different perspective, because the important question to ask and answer in this is, how much do you risk on every trade? So for those of you out there, be honest. Do you even have a clue as to where to even start to figure out how much to bet on each flip of the coin to maximize the return after 100 flips? I mean, most people, it's like they might as well throw a dart. They have no clue.
Mhm.
And don't worry. Almost no one in the industry does. You're not alone, right? So what I'm going to do is I'm going to help you out by making this a multiple choice quiz.
Okay.
And the question is, how much of your $100 are you going to bet on the first flip of the coin? And whatever your decision is, you're just going to stick with that decision. And so here are your choices: 10% of your account on each flip of the coin, 25% of your account on each flip of the coin, 40%, or 51%. Now, what that means is that if I start off with $100 and I bet 10% of the account on the first flip, I'm going to bet $10, right?
Mhm.
And so if I flip the coin, it lands heads up, I win. And so I win $2 for every $1 that I bet. And that means that I win 20 bucks. Now
Okay.
my account is at 120. I bet 10% of that, which is $12. If I lose $12. If I win $24, et cetera, et cetera. You repeat that process for 100 times, right? So the question is, which one of these is going to yield the most growth in your account based on a situation where the game is rigged in your favor? It is literally a no-lose situation. So this should be a fairly simple question to answer, right?
Mhm.
It should be fairly obvious.
Okay.
So go ahead and decide which one. If you're listening and you're watching today, go ahead and decide. Just go ahead and write down 10, 40, or 10, 25, 40, or 51.
Okay.
All right. So we're going to go through these just real quick. 10% of your account on each flip of the coin turns $100 after 100 flips of the coin into. What do you think it does, Lex? What do you think your $100 grows into after 100 flips?
After 100
Just guess.
flips. So
Yeah,
you did one before, so it's got to be 10 times. So it's 1,500? No.
1,500. Okay, that's a good guess, actually.
Yeah.
No, that's a real good guess, but it's 4,700.
Jeez. I was
Yeah.
way off. That's not a good guess.
Yeah.
I always traded 1,000 lots though. So, I mean, is that good?
You're going to be risking a little more than $100.
Right.
All right.
Okay.
So $4,700. So you just turned $100 into $4,700,
Okay.
right? Instead of 150 by betting $1 on every clip. So let's keep going. 25% of your account on each flip of the coin. What do you think?
Is it going to be 2.5 times more? That it's probably not, right?
I don't know. What do you think?
I don't know. Let's show me the answer. This is hard.
All right.
Wow. It's not 2.5 times.
36,100. No, it is 360 times.
Right. Okay.
Is that not
I hope you're
mind-boggling?
going to explain this to us. This is great.
The math is in the book, actually. So
I will take it. We'll take it. We're going to believe you.
I'm not going to bore you with the math, right? All right. So 25% does that. What do you think 40%? I mean, we just went from 4,700 to 36,000 in a no-lose situation. What do you think 40% does?
Where were we last time? 25. So we're like in the factorial world here. It seems like.
Right?
Right?
I mean, yeah, it's just mind-blowing.
Okay, I don't know. It's 6 digits.
All right, yeah. Okay, that's 4,700.
What?
Yeah. 47.
Yeah.
You're going the wrong direction. Yeah, there's a bell curve here.
Got it.
There's a bell curve, and you have to understand what affects this thing, right? So 51% now. If some of you may have chosen 51%, no lose situation. Why not? Mm-hmm. Right? What do you think? 51%.
Well, it feels worse now. I'm feeling bad all of a sudden.
Well, we know we're going the other direction, right?
Yeah, right. That's what I feel like.
Yeah, your $100 drops to $33. You, in a no-lose situation, you lose money because of trade size. Right. And traders don't. I mean, look, the difference between making 36,000 and losing 70 is trade size. Right. So how does someone lose money on a no-lose situation? It is trade size. Trade size. I preach this until I'm blue in the face, and unfortunately, it takes a while for some traders to realize, okay, now I realize what he was talking about.
Okay, let me ask a question. Let me interrupt, Ray. Okay.
Yeah.
So without the mathematics of it, which we're not going to go through, intuitively, here's what it seems like to me, right? At 51% of your account size, you could have the random 3 heads in a row, random, 3 tails in a row, whatever, and lose that opportunity, in which case you blow yourself out quickly. Whereas if you're doing small little bets of 10%, you have the ability to push the mathematics and the variableness to your favor. So same concept of roulette. I know it's against you at the table, but why would you want to put one gigantic bet on one number when you can play the whole table? That's why casinos are on the other side. They want as many roulette tables out there and have small bets across the table, because they might lose one for a big number, but they're going to keep making and grinding that stuff back. Is that kind of conceptually where this is going?
It is. Obviously, so there's martingale, there's anti-martingale. If you're a bettor, and there is no money management that can theoretically turn a losing strategy into a winning strategy. Okay. Right. So if you happen to go on a streak and you're using some risk management strategy, then you can do well, but long run, it doesn't matter. You cannot turn a loser into a winner with risk management. Mm-hmm. You can diminish the risk. You can create a lower probability of losing, because you can take advantage of streaks and whatnot. But that's going into a whole other area. With this particular thing, what I want to drive home is that this is a fixed situation. How much more important is it to understand your trade size decision when the probabilities aren't fixed in your favor? Mm-hmm. You may have positive probabilities. In fact, I strongly suggest that traders limit what they trade to probabilities that are favorable. And you can get favorable probabilities, but probabilities are not certainties, right? So how much more important is trade size when you have a good probability, but you don't have a certainty? And it is absolutely critical important. And so, basically what the whole trading world has traders focused on picking the next ballistic stock, getting rich by doing penny stocks or doing market direction, finding the holy grail strategy. We talked about that before we started this session, how some people are just looking for the risk-free strategy, and it just doesn't exist. But the thing is that you don't need it. And this is the wrong focus that the industry has you on. This is basically the tail wagging the dog.
Okay.
When you focus on the strategy first and expect that to be the source of your growth, that's the tail wagging the dog. And you have to do it the opposite way. So I'm telling you right now, you mark my words, the only realistic shot that you have at becoming $1 million trader is to understand trade size. Period. End of story. I don't care how great somebody can pick stocks. Your only realistic shot is by understanding trade size.
Okay.
And so
yeah, sorry, right. It's a great point. I can be honest with you. I have yet to talk to someone in your position, meaning an educator, mentor, trader, who's focused this hard on trade size. So this is great. I'm complimenting you on this. This is fantastic. And I can tell you this, when we traded on the floor, we didn't concentrate on this as mathematically and as focused as you did. We had an intuitive sense of this, but nowhere near what the time you spent on this. So this is great learning moment. I think I really appreciate you offering this.
Good, because it is the most important. I saw it in 1995. That's when I first, 1994ish. That's when I first started looking at it, and I am as convinced as I've ever been that this has got to be the focus, right? So what traders don't realize is that when you actually understand trade size, it actually dictates the type of strategy that you look for. You're not looking for the holy grail anymore. You're looking for what compounds the best, right? You have a completely different mentality on how you approach trading. So here, try this on for size. All right. Now, you have to understand that the risk management strategy that I just showed you is not a one size fits all. Okay, that was illustrative purposes only. It is not what you should use in trading. All right. But if you use the right compounding strategy and you have a low risk strategy that produces a small weekly income, you're talking about significant growth. $10 a week. Did you realize if you can make $10 a week, just average $10 a week, that's it, in a low risk strategy, you can grow a $5,000 account into $40,000 in 5 years. $10 a week. Wow. Right? That's that's $2,600 if you don't compound. Right? So that compounds into 40,000. If you can increase your average to $25 a week, look at the difference. Wow. $25 a week compound into 215,000. This is math. So if you average $25 a week in a certain type of strategy, you will achieve this kind of growth, right? So,
and that's assuming the trade size as well that's implemented in here with the correct strategy.
Yes. Right. This is following the compounding plan. So you start with 1, go to 2, go to 3, go to 4 at certain increments, right? So if you get to where you're getting really good at your weekly strategy and you're making like $50 a week on average, non-compounded, you then compound that for 5 years, you're talking about 849,000. I mean, there's nothing you're doing right now that has that potential. I promise you, there's nothing, right? So you get to $75 a week, you're at 1.9 million. You get to $100 a week, you're at 3.4 million, and it's math.
Right.
So $100 a week, that's hard to do in a low risk strategy. You have to take a little bit more risk to get up there, which slows down the compounding. And that's where you have to understand, how the trade size works and how it doesn't work with the strategies, because a higher risk strategy is going to compound slower.
Well, is that the drawdown theory then, Ryan? So higher risk, you're gonna have losses, right? So we're going backwards on more often than we would like.
Yes. And so you have to compound that slower to take into account the higher risk.
Okay.
Right. So lower risk compounds more efficiently. And there's more to it than that, but you get the idea. And it's very straightforward once you understand the basics of it. So if you can find a low risk, high probability strategy and you can produce $20 a week, that's it, and compound it over 20 years, you're talking about growing your account more than if you were to buy Netflix at $10 and write it to 380 a share. right? So that happened in like 2012. If you held on for 6 years, you would have seen it grow to $380 a share. Well, that turns your account into $188,000 in 6 years. Okay, so if you put 5,000 in Netflix, put the whole thing in Netflix, and said, okay, I'm just going to hold it, and you held it until it reaches, it reached $380 a share. You're talking about growing your 5,000 into 188,000, right? That's an astronomical growth. How many people actually did something like this? Right.
Here's where I get out. I got out right about, the middle of the graph there.
Yeah,
I was
that's
so
what
happy.
most traders do.
Right.
You're right. Right. That's what most traders do.
Right.
And the difference is tremendous. Well, compound $20 a week, and this is what your chart, this is what your growth chart would look like. Just $20. So you tell me, what is the probability of you being able to generate an average of $20 a week in an option strategy versus finding the next Netflix and writing it up for the next 6 years and not getting out because you just right? The probabilities between the two are just there's such a large gap between them. It's not even funny. It's barely you can even mention it. So that's why.
Let me ask a question. Sorry, Ray. I'm getting a question.
Yeah.
Let me ask this while we're talking about it. So the question is, this obviously takes discipline, right? To pick $20 off the money tree on a weekly basis is a massive discipline exercise. Agreed? So, what can you speak to about that? I mean, you're going to have drawdowns, or not drawdowns. I guess that's wrong. You're going to have losses, I would imagine. So, how do you quantify the discipline aspect of $20 a week when you know how we all are? We're greedy. We want $20. Let's make it 40 while we're at it,
Yeah. Well, there's different aspects to it. And we're talking about averages. So it's not that you go for a $20 target and then you're done.
Yep.
Because you have to account for the times that you're going to lose. Right. So you're going to, some weeks you're going to make $50, some weeks you're going to make $70, and then other weeks you're going to lose $50 or $70 or $100 or whatever the case is. So we're talking about averaging it over time. If you can average $20 or $25 a week, then you're doing well. So, as far as discipline is concerned and doing it, simplicity, that's the best way to overcome the discipline issue, is to keep it simple.
Got it.
To where, one trade a week, let it, leave it and set it, let it and go, type deal. Right. So that's what I'm going to start focusing. That's what I'm going to kind of give a foundation for with part 2 of this, which is actually showing you a high probability, low risk weekly option strategy that I trade. And it's designed to average between 25 and $75 a week. Okay,
well, that's the bigger number on your. Yeah, that's the bigger number in your scales. We're all happy about that number in 5 years.
It is an uncertain market, so I've got guys who their first 4 or 5 trades, they were averaging more than $100 a week.
Awesome.
With this strategy that I'm about to show you. So it's not going to be that way all the time, but the bar is not high, right? We're not making a killing here. We're not trying to make a killing. So I think you're going to find this interesting.
Okay.
I call the strategy crazy calendars. I focus on SPY, and one of the reasons I focus on SPY is because it specifically has Friday and Monday option expirations. Friday, Monday, and Wednesday, actually. And you can just get some better pricing when you're doing that. So this allows you to lower the risk, leverage it a little bit more. But crazy calendars, really, the theory behind it is to leverage calendar spreads, which by themselves are not that great. So we'll get into that as we go through here. But this is why most traders ignore calendar spreads. They don't realize there's actually a pot of gold there if you know how to take advantage of them and leverage them, and you know how they work. And so it is ignored, but when you bring in SPY and Monday, Wednesday, Friday expirations, and you learn how to leverage those, everything changes on this thing, as you're about to see. So here is a crazy calendar trade that I placed on today. And this crazy calendar trade, I don't know how well versed the audience is in risk graphs, but I'm just going to explain it really quickly.
Sure.
This is basically a risk graph that shows what the trade is going to make at the day of expiration based on wherever the underlying market is.
Mhm.
And so today we closed at about 384. If on the day of expiration of this trade, which is February 5th, if we're trading here at 384, then this is projected to make about $70.
Mhm.
Okay. If stocks crash, it's guaranteed to make 37.
Okay.
Okay, guaranteed to make $37.
And that's this
Right.
value in
So
your credit spread, right? Or the credit of that
right.
spread, right?
Yes. Yep.
Got it.
Yep. That's the credit. So we create a credit that creates an minimum gain if stocks crash.
Mhm.
$37. You're trying to average 25 to begin with, right? So that if stocks crash, your minimum is still above what you're trying to average.
Mhm.
And so that's really good, right? And then if the market trades up at around 390, then this trade is projected to make $400
Mhm.
on the day of expiration. And then it starts to come off, and then it goes into a risk, and the risk is about $300, way up here. So the probability of realizing the risk is very, very small. But we'll get into all of that here in a second.
Mhm.
And there are actually several ways to achieve the concept of what I'm trying to do here, which is basically the power of the approach is the concept behind what we're trying to do, which is very important because
Mhm.
normally I do not hold on to this trade until expiration day. And for several reasons. A, I'm not trying to milk this thing for $400. I'm trying to average $25 a week. This just makes it very, very high probability that I will be able to achieve that goal because it gives me certain capabilities. But the first thing that I do with all of these trades, and you don't have to, it's just a personal thing for me. I don't like to lose money if stocks crash, even if it's only $20. I just don't like to lose money if stocks move down. So I always create a credit. And if you create a credit on these, that just means that there's no risk to the downside. You have a
Mhm.
minimum gain, whatever the credit is, and it's just it's more of a my thing than it is an absolute rule behind the strategy because there are traders, students of mine, who will play small debits because they emphasize something else about the trade.
Mhm.
All right,
Okay.
so I just tell you what I do. Then the second thing is that I try and push the risk as far to the upside as possible. And the further I can push the risk to the upside, the higher the probability is that I'm going to be able to pull out a profit on the trade, right? So this is a pretty decent probability trade right here. It's set at about 77% if I were to hold on until expiration, which most of the time I do not. But here's the third concept, or the third piece of this concept, if you will,
Mhm.
is that what I've done is I've created a scenario where there's a profit zone, and this profit zone is increasing. And so as the market moves up, it has to go through this profit zone first before it ever reaches the risk level.
Mhm.
All right. So this increases the probability of me being able to take a profit on this trade before it ever gets to the risk level. Now, that's not guaranteed. It can actually move up far too fast and move right through this risk zone, or even I've been in a trade where it actually jumped the risk zone and
Right.
never gave me an opportunity to get out of the profit before the end of the trade. And so it's not guaranteed, but it is just another piece of the puzzle to increase the probability of success on the trade.
Let's do a
So
question,
this is
Ryan.
one.
Right. Let's do a
You
question.
bet. You
Okay.
bet.
Here's
Yeah.
why, because I don't want to forget this. So once you said about the profit zone, question's this. And I'll just draw a little bit. You said you have a potential when you get toward the profit zone and possibly make a decision to take something off, to take it off, right?
Yes.
Okay, the
Yes.
question is do you take it all off or do you take a percentage off? Now, obviously, if you're doing a one lot, you can't take half of a one lot off or a quarter of a one lot. So what's your feeling there? Or is there an answer at all?
Yeah, there is an answer, and the short answer is that I take the whole thing off,
Okay, good enough.
and there are reasons for that, which really go way beyond the scope of this call.
Okay.
But the simple answer is you take the whole thing off, you walk away with whatever profit you have,
Hmm.
and then another question, if you don't mind, because I know I get I do these calls a lot, so I get the question, so I know kind of where they go.
Yep.
Is what if it does jump the profit zone, doesn't give you a profit, and let's say you're trading up here at 393, 394, somewhere around there, before expiration, do you go ahead and get out at a loss if it's lower than the projected loss? And the answer is absolutely not. And there are reasons for that, but you got to let the probabilities play out. There are probably twice over the last 3 months where I've been in a trade, and I do this very consistently. Twice where I've been in a trade, it jumped my profit zone and was trading up here, but then by the time the expiration actually rolled around, it moved back down into the profit zone. I actually had big profits.
Okay.
So what I tell traders is when you place on a trade, you have to be willing to accept the risk of that trade, period, end of story. If you're one that you're going to panic, if it goes up in here, you're losing $100, don't take the trade.
Okay.
Right. So
I understand.
That's my rule.
Okay, good. And let me go to the next question because it all flows in. So you said you got to leave it alone up here. Yeah.
Yes.
Okay.
Leave it alone.
I guess I can't see any farther to the right. Are we unlimited loss, or are you net flat units? And that's my term. They didn't ask that question, but what is my ultimate risk? Is it infinity, or are we capped?
In this trade, it's $300.
Okay.
So you are capped at $300, and that's going to happen at it's actually the risk graph is actually better than what this looks like. And the reason, or the reality of it is actually better than what the risk graph looks like. And the reason is because calendars, and I know I'm probably going to get a little more technical, but it's calendars hold their value when they're in the money more than they do when they're out of the money. And this profit zone is created by the calendars.
Got it.
And so as the market moves up, those actually hold on to their value more than what this risk graph shows. So that $300 max risk approximately is like way up here to like 398, 399.
Okay.
Which has about a 6% shot of happening. Right. So it's not a high probability at all. Okay.
Okay. Got it.
All right. So with that, with this particular trade, if you hold on until expiration, so no early exit strategy, period, you have a 77% probability of success. Okay, that's to the break-even point. Beyond that, your average win-loss ratio is actually quite significant, and you have like a 3-to-1 average win-loss ratio with this trade. So you have a 77% probability with like about a 3-to-1 average win-loss ratio. You do that 100 times, and you've got a decent trade on. But moreover, because this is in SPY, it's not absolute, but there is a governor in place, right? And speaking mechanically, like you have a governor on your car. There's a resistance that the farther the market moves up, the broad market, the more resistance it has to continue. You're not going to see SPY do what Tesla did,
right,
in 2 months and double in 2 months. You're just not going to see it unless it already tanked. So while it's making these new highs, so we've got a resistance up here as well that is also not taken into account with this probability. This is purely a math probability. It does not take into that characteristic of SPY into account. So there's a lot of good things about this trade. And if you implement an early exit rule, you actually increase the probability of success even more than what is shown, right?
Yep.
So there are different ways to put on this trade. I'm going to show you exactly what that trade was here in a minute.
Okay.
But there are different ways to put on this trade. There are some trades that have a little bit more risk. This trade has more risk, but because I was willing to take more risk, I actually pushed the break-even point all the way to 400. All right, that's 16 points away, and it has about 2 weeks to hit there. The probability of that happening is 95 of this staying below 400 is 95%.
Okay.
Pure math, not taking into account the governor aspect or anything else. But then if you employ early exits with this particular variation of the crazy calendar, you push that probability up in excess of 98%.
Wow.
Right. So you can create very high probabilities of producing a small loss and keep your risk limited to the upside. You just obviously have to accept whatever risk that is associated with this particular trade. And on this particular trade, the risk is actually about $500, but that $500 doesn't happen until like 407,
Got it.
408. The probability of that happening is almost not even
Right.
worth
So
mentioning.
you're pushing 3 SDs there, right? So here's 2 SDs
Yeah,
somewhere in that
yeah,
ballpark, and we're way out on the wings on
yeah, yeah.
the upside there. Okay. Nice.
In a market that's at all-time highs and has a governor
Right.
in place, right? So
Yep.
that just kind of gives you an idea of how you can manipulate, if you will, the type of trade that you're wanting to take based on what you favor. Do you favor higher probability, or do you want a bigger profit potential on the trade type of deal?
Got it.
Right. So but one of the key things is to make sure that you understand that the goal is not to try and take a $500 profit on this trade. Okay, because the probability of that happening is also very low, like
Mhm.
really low, because what you're requiring is there's one peak that will generate about a $500 profit, and that peak has to happen right at the close on expiration. So you're requiring SPY to close at a certain price on a certain date in order to capture this $500 profit. It's
Mhm.
not going to happen. And so it's ridiculous to think that, hey, I'm in this trade and I'm going to make $500 on the trade. It's not going to happen. That's not why we're in it. You can't expect that.
Right.
The further I can push this up, this profit peak, the further I can push it up, the higher the probability I can give myself on pulling out any kind of profit, right? And again,
Mhm.
I'm only trying to get $25 a week on average.
Right.
Now there are times where you're going to have an opportunity to pull out a bigger profit, $200, $300, $400.
Mhm.
I pretty much I suggest just taking a max target of about $150. If you get $150, man, you've got 7 weeks of average
Right.
of what you're trying to go for right there,
Yep.
right? So that's
It's a good point.
so that I did want to mention. Yeah, I wanted to mention that because that's not why we're getting into this trade. It looks like a tremendous trade, but this is not why we're getting into it. Okay.
Mhm.
All right. So let's break it down a little bit.
Okay.
We're going to start with the calendar spreads, because the calendar spreads are what creates the profit peak. And what creates a profit peak in this is 3 calendar spreads: short Friday, February 5th, 390 calls, and long 3, February 8th. That's Monday, 390 calls, from a debit of 29 cents each. That's $87 debit total. If I were to just put the calendar spreads on, this is why traders don't trade calendar spreads.
Mhm.
They're a dog. You just don't trade them, right?
Tell me about
The
it.
reason is because you have a 32% probability of success with just the calendar spreads,
Mhm.
and that's not good. So yeah, you can increase that probability a bit by having an early exit rule. You also can increase a little bit when you're talking about the probability of the market actually moving up here to 398, where you're actually going to start losing money on this. Is low probability that's not accounted for in here. But still, what has to happen is the market has to move up. You're now requiring the market to make a move in order to make money.
Mhm.
I hate that. I
Mhm.
do not like requiring the market to have to make a move. I like time.
Sure.
And that's what this trade right here is: time. That's what this is. I make money on time.
Okay.
And so this is not time. This is market movement.
Mhm.
And so that's by itself. So the key and the concept here is to find a way to pay for those calendar spreads,
Mhm.
right? So by paying for the calendar spread, and by bringing in money through some sort of strategy to pay for the calendar spread, you escalate the probability of success to what we saw in the total trade,
Okay, so
right? So
let
that
me
brings in this.
sorry, Ryan, let me
Yep,
interrupt.
yep.
Sorry about that. Question. So we're going to combine. I'm assuming we're going to combine some sort of credit spread here to get that $87 at 29 cents each out of the equation, right?
Yep.
Go to the
Yep.
go
Yep.
to the credit side of the ledger somehow, and importantly, being not short units here. Is that right?
Exactly.
Okay.
That is correct.
Okay.
Right. So here's the trade. And this is just one variation. There are a lot of different ways to pay for these things.
Okay.
Right. So here's the variation. It's short 1 February 5th, 388 call, and long 1 February. That should actually say February 8th.
Okay.
So this is a diagonal spread.
Yep.
You can do a credit spread. You can do a diagonal spread. You can do other types of spreads as well. But this one is fairly simple. So you have this particular diagonal spread from a credit of $1.24.
Okay.
All right, so that's the red line, and you can see how it interacts with the calendar spreads, right? So it's kind of like a 1-2 punch type deal. The thing though is that you can place this whole trade with one order, so you don't have to place two orders. You don't have to place the calendar spreads, and then you can, and I actually do quite often because I can get better prices that way. But you don't have to. You can literally just put this order in. This is the credit. This is the order that has the credit of 37 cents total, and that's what the credit spread, or the diagonal credit spread combined with the 3 calendars, is what creates this graph. The profit zone, the credit, et cetera, right? So it's you're just kind of thinking outside the box. I want to use credit. I want to use calendar spreads, but I want to pay for them because calendar spreads alone don't have great probabilities.
Got it.
But if I can combine another trade that's symbiotic or synergistic with those calendar spreads, then I've got a whole nother story.
Yeah, let's do a question, because I want to make sure people understand this, because you added this other element, and I want to make sure it's clear. So first of all, folks, this is supposed to say the 8th, I believe, is what Ryan said, right? So
yes, that should say the 8th.
Yeah. So the question is are all your longs always in the same month? Meaning, could that Feb 8th be the next weekly, whatever that is, or the next 3 days? Is that ever a strategy, or is it always front month, or front weekly, I should say, and next term?
There, you can do almost anything you can imagine as long as you keep the concept intact. And so, you can increase the complexity of this by going further out with the credit. In fact, I have one of these where it's further out this week. But that goes in, again, one of the things with discipline is keep it simple.
Sure.
You can always increase the complexity once you have things going, because this is what I strongly push traders to do, is learn the simplicity, get $25 a week.
Yep.
And then once you're doing that, then increase the complexity in order to increase your overall average profit. Right. So this is just the beginning. And you can actually be more simple than this, but this is one of the lower risk ones. And it's honestly, it's one of the ones that traders should start with. It usually takes traders, depending on their experience with options, it usually takes between 3 and 6 months to get comfortable with these things.
Sure. Let me make a note too, while I'm at it too. I just noticed something I want to make clear to the folks too. So notice this part of the spread. This is that wicked calendar spread. Okay. It's also 3 times the size of this diagonal, correct?
Exactly.
So
exactly.
I want to make sure that people understand that Ryan generated this spread as a debit. It was 29 cents, if you remember from the slide, times 3 is 87 cents. That's what he paid for this in total. And then he threw out a 1-lot spread at $1.24, I think it was, right, to get to this number. So it's a credit all the way around as a package, and it's a 3-by-1 if you look at it that way. Sort of weird, but it's still flat units. The units don't go beyond, right? Because you've got this spread that's unit neutral, and you've got this spread that's unit neutral. They're just in different ratios to one another, still creating that credit. Okay.
That's correct.
Okay. Awesome. I love the graph, by the way. This is very instructive, where you can see how the combination of these spreads play out into the final tally here. That's good.
Yeah. This is actually from my PDS Trader
Got it.
options app.
Perfect.
So yes, it's tremendously useful for me and traders in general, which is why I had it created. All right. So that's the trade. That's the first variation of the trade. you can place the whole order or the whole trade on with one order. You can place a profit target. If you want to be really conservative, you can place a profit target of $50 to $75,
Mm-hmm.
and just forget it until it's time to until expiration. Either at expiration you're going to make money if it hasn't hit the $50 or $75 profit target, which
Yep.
most of the time it will, or it might be in a loss area, and you just close it out and place the next trade.
Mm-hmm.
Now, the great thing about this is that if this is actually a loss, it means the market has made a much bigger move higher,
Mm-hmm.
which increases that governing factor.
Okay.
And so I can actually be a little bit more aggressive with this, knowing that there's a little bit higher probability that the market is either going to pause or move
Mm-hmm.
down or not move up as much again.
Okay.
Right.
Got it.
So I don't mind this at a loss at all. In fact, what I do is I actually go a little bit bigger. So a little
Okay.
bit like a martingale type deal.
Yep.
I don't suggest that you do that, but once you've been doing it long enough,
Mm-hmm.
you get a feel for the probabilities that after you suffer a loss. Which I haven't suffered a loss in one of these in like 3 months.
Oh, wow. That's great.
So
Good.
it is rare if you have
Right.
a high probability. Now there's been a couple of times where I mentioned it jumped my profit zone, it went into the loss, and if had it stayed there, I would have lost.
Yep.
But both times it moved back into the profit zone.
Right.
And it's funny because my students said, you got lucky on that one. I was like, no, I didn't get it's not luck. That's how markets move.
Right.
Right. So
Let me ask you a question about governor. I see one pop up here. Can you
yeah.
explain that a little more? What you mean by that? I think I know what you mean, but I'm gonna let you explain it. What the governor means. I think it's pertinent to the spies as a product. Is that what you're talking about?
It is.
Yep.
You cannot apply the same concept to Tesla, for example,
Okay.
because Tesla, an earnings report comes out in Tesla, and you might see this thing. You might see Tesla jump up 15%
Right.
in a day.
Right.
You're not going to see SPY jump up 15% in a day,
Right.
right? Unless it had crashed. If it
That's when you see
crashes,
big
all
moves in the
bets are
market.
off.
Right.
Yeah, yeah. So while it's up here, there's just going to be this natural limitation of it moving up by a certain amount. Now, that doesn't mean that it can't move up into the risk zone. What I'm saying is probability-wise, and we still have limited risk no matter what. So
Mm-hmm.
even if on just a bizarre situation where the market screamed higher by 10%, during the length of this trade, I'm still absolutely limited in my risk. I don't want to just say, well, it can't do it,
Right.
and therefore I'm not going to play it.
Sure. Right.
But
So,
I'm speaking with regard to probabilities.
yep, I get it. So one of the things that we always talked about in our trading business, relative to the governor, we didn't use that term, but think about this: spiders can't be taken over. There can't be a takeover in spiders, right?
Right,
it represents the macro market. So there's a
right,
natural, not a ceiling, but there's weight to the upside in a grand macro type product. Tesla can be taken over, like you said. Tesla can have earnings that are unbelievable or horrible, and they can have a binary event that is just beyond standard deviations that don't make mathematical sense, right?
right,
You won't get
right,
that in a spider type product that is a macro type product. I mean, unless
right.
God, the world comes to an end or something like that, right? So
Well, if that happens, it's to the downside, which I'm
yep,
guaranteed to make
you're already,
$37 on
you
this,
just have to be
right?
able to
So,
collect it.
right, exactly. Well, everything is worthless.
That's
Everything
right.
is worthless. So by the fact that it's worthless, I collect it.
That's right.
And that's what So it's not yeah. So I understand a lot of traders. This is kind of new, a
Mm-hmm.
new way of looking at option strategies and whatnot. But once you watch it for a few weeks, it really is a simple concept, and then you start learning the different variations of how to achieve, basically the same concept, only by focusing maybe on higher probability, or maybe you want to focus on bigger profit potential. Because if you're willing to take a little bit more risk and a little bit higher probability of realizing that risk, but you can increase your average profit to $75 a week
Mm-hmm.
because you're focused on compounding, it's
Yep.
a whole new ball game.
Okay.
right? So you can do different variations, higher probability, bigger profit potential, more bullish leaning. You can do more bearish leaning.
Sure.
For example, to make it more bullish leaning, this particular one, all you have to do is add another calendar spread,
Right.
right? And you
Yep.
still got a credit of 8, all right? So you're not going to make a whole lot if stocks crash, but you'll make $8,
Right.
minus whatever costs
Yep.
are involved,
Mm-hmm.
which I strongly suggest a no-cost broker, no
Mm-hmm.
commission broker.
Do you
But
have one in
with the
mind?
I use Tradier.
Do you
I
see the
use
one behind
Tradier.
me, Trade Year?
that
We,
that's the one I use.
okay, good.
So
Yeah. So let me ask you another question. So what this four by one or the 3x1 even?
Yep,
Do you have a flavor or feeling for the margin requirement on something like that? It's got to be small, right? It can't be a lot
it
of money
is.
to
It is.
maintain this position. Any thoughts on that?
It this piece right here is $400.
Okay, that's crazy,
Right. So
right?
this trade right here is $400. Yeah,
Right.
yes, $400.
Awesome.
So when I say start with a $5,000 account, you could suffer the max risk 10 times in
Right.
a row and still trade.
Right.
Right. So
10 tails in a row.
10 maximum losses in a row,
Right. That's
which
right.
means that the market's going to have to move up 10 times in a row 5%
Right.
or more.
Yep.
Right. It's not going to
Awesome.
happen.
Awesome.
Right. So that's so that's why I say learn this. Do what it takes. Do what it takes to learn this, because the compounding of this is astronomical. So,
Sure.
my question is, do you think that you can place on a single crazy calendar trade a week and average $25 based on what I've shown you?
Yeah.
You think that's
Absolutely.
something that you can do? Because if you can do that, you're talking about, 6 figures in 4 to 5 years.
Awesome.
And I just, so, I'll go ahead and just let everyone know that I do these live trade calls where I
Mhm.
talk about
Sure.
these crazy calendars twice a
Plug
week,
away,
every Monday and Thursday.
Rye.
I'm
Plug
gonna
away.
I'm gonna give
Start
a plug.
plugging.
If I gave you the information, right? So
Yeah.
if you want to learn more, if you like what you saw and you want to learn more, and I mean a lot more,
Right.
you can attend these calls. So I'm actually doing one tomorrow, and I
Okay.
take a live trade every single call.
Got it.
And
Got it.
explain different strategies, different variations.
Sure.
So that's the first thing. The second thing is, if you want to really learn compounding,
Mhm.
yeah, you can go get the book, but I've actually done a 10-hour, and that's going to drive people nuts, but it's a 10-hour online video course on
Okay.
on nothing but compounding.
Where
You'll
is
become an
that? Where do
expert.
they find that? Is that something that's a paid product?
It is a paid product, and
Okay.
it's normally $997. And you go to fixedratio.com.
Okay. Hang on. Let me put that in the
So
chat. Fixedratio.com.
yeah,
Go ahead.
yeah.
I got it.
But
Fixed
they
ratio.
don't
Got it.
fixedratio.com, but they don't want to do that. Okay,
Okay.
because if they do that, they're going to pay $997,
Got it.
right? And for these live trade webinars that I do twice a week,
Mhm.
they're $199 a month.
Got it.
Right. So for your guys, Lex, only, I'm giving you everything. 6 months of the
Wow.
webinars, live trade webinars, and I basically throw in the compounding course for free, because it's that
Okay.
important, and I want everybody to
Got it.
be able to take advantage of that.
Okay. So
So
what do they need a code for that? How do we want to work that?
if they will text, they can either call Spring,
Okay.
and leave a voicemail if she doesn't answer, but leave a voicemail.
Okay.
She'll call back
Got
to
it.
make sure you get on board, or you can text crazy calendars
Got it.
to 855-943-5380.
Okay. I'm typing away here. I'm
And
putting all this in here, but
yeah,
so it's going to be on the production of this afterwards. So that's great.
good.
Texting, and then maybe if they indicate they saw you on the Options Brew TV or something like that, you'd get the connection somehow. That'd be fantastic.
Yes, yeah,
Perfect. Oh,
yeah.
that's awesome.
Just yep.
Great.
So it's there's a lot more.
Okay.
A lot more. This is
Yeah.
just the tip of the iceberg.
Perfect.
So
Awesome. This is
yeah,
great stuff. This is the kind of stuff, this, again, I always emphasize to folks, look at, Trading in today's world is different. Okay. You need folks like Ryan out there to explain these strategies, understand them, make you understand them. Clearly it costs money. He's not doing this stuff for free, but this is not seen anywhere, this kind of content and this kind of information. Was terrific, right? Great job. We really appreciate this.
Good, good.
Yeah.
Great. I appreciate you having me on.
Yeah, really fascinating. I mean, I got to tell you, you're one of a kind. So I haven't seen this this sort of presentation.
Fixed ratio or paydaystocks.com.
Okay, let me put that in there. Payday stocks. Got it. Okay.
Yep.
Got them both out there. So you can find Ryan in the whole information there. So fantastic stuff. Ryan, thanks so much.
Great. Thanks again, Lex.
Okay.
Appreciate it.
Talk to you soon. Bye, everyone.
All right.
Bye.